Hello and very warm welcome to Victory IAS. We are doing current affairs, right, related to banking sector first and banking sector. It is continuation of the topics that we have discussed in the last class, right? RBI framework on Indian banks, foreign businesses. So whatever Indian banks they are involved in foreign businesses. So what kind of regulations that the RBI has come up with. So on 1st December, the RBI has unveiled a framework allowing overseas subsidiaries and branches of Indian banks and financial institutions to undertake activities that are not specifically permitted in the Indian domestic market. The framework has been implemented with immediate effect. So what are the key features of that particular framework that we have to understand? The framework allows Indian banks, foreign branches or subsidiaries, as well as all India financial institutions like, for example, SIDBI, NABARD, etc. These are all India financial institutions to deal in financial products that are not permitted in Indian domestic market without prior approval from the RBI. Right? The new rules are applicable to all banks regulated by RBI, excluding cooperative banks, regional rural banks, and local area banks, and all India financial institutions. AIFIs are all India financial institutions. These relaxations are subject to certain restrictions like parent banks or all India financial institution requiring prior approval from their boards or concerned authorities in respective jurisdiction while dealing with such products. While dealing with such products means which are not allowed in domestic market, but since they are involved in foreign businesses, right? And They are also subject to compliance with specific regulations and conditions that are put in place by the RBI and the respective host regulators that we need to understand. The activities of Indian banks, foreign branches and IFSCs are subject to Indian laws, specifically exempted, right? The entities that come under new rules must have adequate knowledge, understanding and risk management capability to handle those products which they are selling in foreign markets, which are not there in domestic market, right? They can act as market makers for such products only if they have ability to price or value such products. The pricing of such products is demonstrable at all times. Their exposure and mark to market on these products must appropriately captured and reported in the returns filed to the RBI, right? Financial products dealt with by the foreign branches and subsidiaries as well as IFSCs will attract prudential norms like capital adequacy. Capital adequacy means where we measure the financial health of the bank. For example, this is capital adequacy. We measure in terms of CRAR or CAR, capital adequacy ratio, or capital to risk weighted asset ratio, right? CRAR or CR, that is under Basel norms and all, exposure norms, periodical evaluations, and other applicable norms. Now, RBI revised bank locker rules. Now banks are offering locker services as well, where you can put your confidential important documents, etc. So what are the revised rules related to it? RBI revised bank locker rules will come effect from January 1st, 2023. What are the revised bank locker rules? The revised bank locker rules were released by the RBI on August 2021. All the existing locker depositors are required to provide proof of eligibility to access renewed locker arrangement, right? Some of the key features of the new rules, like for example, model locker arrangements, lenders are directed to use the Indian Bank Association drafted model locker agreements, which was created as per the Supreme Court orders and guidelines. The banks are required to ensure that no unfair terms and conditions in their locker agreements, right? The terms of agreement must not be more onerous than required in ordinary course of business to safeguard the bank's interest as well. CCTV cameras in safe deposit areas. What are the rules or the new challenges that are there? New rules and new features, the policy features. The banks are required to install CCTV cameras at entry and exit points, right? At the of the strong room. Strong room means where locker facilities are there, and the common areas of operation. The guidelines mandate preserving CCTV cameras recording for a minimum 180 days, right? The DVR machine, which is recording the entire CCTV cameras recording. So on depending upon the hard disk capabilities, the kind of number of days that are kept there, right? So 180 days are needed. If any customer has complained to the bank about theft or security breach, of his or her locker, the bank must preserve the CCTV recordings until the police investigation is completed and the dispute is settled. Many a times we have seen sometimes during investigation the CCTV data etc. gets lost, and it is an important evidence in the court of law. Depositors can get up to 100 times the bank charges if the values stored in the vaults are for example ransacked or lost due to the fire or building collapse. However, banks are not liable for the damage or loss caused by natural calamities or act of gods, right? This became popular with a movie also, what is act of god etc. Government raids, right? The banks are required to give prior information to the customer via letter and emails or SMS about the government raid of the locker or articles deposited for safe custody. Example, illegal documents or some illegal things if they are being stored there. Term deposits as rent. So the new guidelines allow banks to demand term deposit also during the allocation of the locker that can be collected as a rent for 3 years. This rule is not applicable for existing locker holders but those with satisfactory operative accounts, right? Now, RBI launches retail CBDT, central bank digital currency. This is CBDC, it is central bank digital currency, as you can see here. After successfully launching the wholesale pilot project for central bank digital currency in November, the RBI commenced the retail CBDC pilot project from December 1, right? CBDC like cryptocurrency we have seen. So RBI is also coming up with their digital currency, right? Central bank digital currency. About this project, December 1st, the first phase of the retail e-rupee. E-rupee, this e-rupee should not be confused with e-rupee. This is different. E-rupee, this is different. This is a voucher, right? This is a voucher. And when we see e-rupee, sorry, e-rupee, this is currency, CBDC, right? A pilot project was launched, initially covers 4 cities like Mumbai, New Delhi, Bangalore, Bhubaneswar, where customers and merchants can use the digital e-rupee, right, or a rupee to make transactions. 4 banks are controlling the launch of retail e-rupee: SBI, ICICI Bank, Yes Bank, and IDFC First Bank. Right, the service will be expanded to include other cities like Ahmedabad, Gangtok, Guwahati, Hyderabad, Indore, Kochi, Lucknow, Patna, and Shimla. For 4 other banks, that is Bank of Baroda, Union Bank of India, HDFC, and Kotak Mahindra Bank, will be involved in the pilot launch in these cities. The scope of this pilot project will be expanded gradually to include more banks, users, and locations whenever needed. What are the kinds of e-rupee that we can see? Based on the usage and function of the digital rupee as well as differences in accessibility, the digital rupee is classified into 2 broad categories: general purpose, that is retail, and wholesale. On 1st November, the digital rupee of the wholesale wholesale segment was launched to settle secondary market transactions in government securities. The wholesale CBDC can be used only by select financial institutions. It was launched to transform the settlement system for financial transaction of the banks in the government security, right? Interbank market and capital market to make them more efficient, secure, and cost effective. What is retail e-rupee? That is what we have discussed here is about the wholesale, and now what is retail? So as we can see, retail rupee is the electronic version of cash. It is mainly used for retail transaction by private entities, non-financial customers, and businesses. It will be in the form of digital token that represents legal tender, right? How the currency notes are there in similar fashion. The e-rupee will be used in same denominations as per the currency and coins that are distributed via banks. It does not earn any interest like in the cash. In the case of physical cash, when we put our money in savings account, we earn some interest on that. But when we are putting our money in digital wallet, we will not be earning any interest on that. It can be converted into other forms of money like deposits with the banks, time deposit, and time deposit, and there is a time deposit, for example, like fixed deposits are there, and demand deposits, like when we put money in our saving account, it is available on demand basis. Whenever we demand, we can avail those money, right? So that is there. User can transact using retail e-rupee via digital wallet provided by the participating bank. It can be stored on mobile phones and devices. The transaction of e-rupee can be both person to person as well as person to merchant, right? Merchant means businesses. It can be transferred to the merchants using QR codes displays at merchant locations, right? This is about the retail e-rupee, or what kind of developments that has taken place in that. Securities Exchange Board of India recently unveiled a new logo on the occasion of its 35th anniversary. So let's first understand SEBI, the functions. Example of SEBI success, for example, uh, when we talk about protection of investors' interest, SEBI is for protecting investors' interest. So protection of investors' interest, SEBI has taken action against fraudulent collective. For example, when SEBI got established in 1988, SEBI was not established as a, as a statutory body. Rather, it was established under Ministry of Finance. It was established under Ministry of Finance in 1988. But when this lot of scams and fraudulent activities was taking place in 1992, after this infamous Harshad Mehta scam in 1992, we saw that statutory rights were given to SEBI. So statutory rights were given to make it autonomous, right? To make it autonomous. That is, it became a statutory body. It got established under SEBI Act, SEBI Act of 1992. When a body gets established under an act, so it become a statutory body, more power, more autonomy as compared to the body established under ministry. Impressive rise, as you can see. Asset under the management of mutual funds, the total number of dematerialized account, also known as demat account, demat turnover, the number of derivative contracts, etc., have grown exponentially. The smooth functioning of the securities market, as you can see, SEBI has introduced online trading platforms and electronic clearing services. Now also we can see, using demat account, the shares are also in electronic form available. Earlier the shares were used to be sent through post offices, etc., in the physical form. Now it is in electronic form. Regulation of security market operation. For example, when we talk about financial market, we are having money market and financial market. When we talk about, so we are having this money market and capital market. So when we talk about financial market, we are having money market and we have capital market, right? So money market is under the supervision of RBI, and when we talk about capital market, it is under supervision of Securities Exchange Board of India, that is SEBI. Introduced regulation for insider trading. Insider trading, if you are having certain important information available, right, being a part of that particular organization or being a part of SEBI, if you are having access to certain information, you cannot use that information to have capital gains out of that. So that is insider trading. It is illegal, right? Delisting of securities and disclosure of investors protection guidelines, right? Education investors, so to educate investors, also education of investors. So as you can see, SEBI's Jan Jagruti Abhiyan to educate investors about the securities market and their rights as investor. Now you can see prohibition of fraudulent, right, frauds that are taking place. SEBI has taken action against market manipulation and price rigging, and in 2015 SEBI ordered a probe into suspected rigging of National Trade Stock Exchange, that is NSE algo trading system, and imposed a penalty of 1,000 crore on NSE for its role in co-location. As you can see, that is unfair practices. So that is related to prohibition of fraudulent and unfair practices, unfair trade practices, right? Now ensuring compliance by market participants. In 2018, SEBI identified, or SEBI fined ICICI Bank and its CEO Chandra Kochar. Chandra Kochar remained in news for many fraudulent activities for violating disclosure norms related to loan given to Videocon Group. So Ms. Chanda Kochar having her husband in Videocon group, and that's how the loan was extended. And this was the disclosure was not there, so SEBI took action against her. Tackling insider trading, that is having information, having sensitive information which can impact the kind of share market, etc. In 2017, SEBI imposed a penalty on Reliance Industries for alleged insider trading in Reliance Petroleum share in 2017. Now, what are the limitations still that we see? This is the kind of success or the kind of development that has taken place under SEBI, but what kind of challenges that are still remain? SEBI has a certain limitation in terms of reach, its reach, enforcement powers, coordination with other regulatory bodies, resources, and keeping up with changing market dynamics. These limitations can create regulatory gaps and overlaps, leading to delays in resolution of cases. Examples, as you can see here, SEBI alleged inaction in the Ketan Parekh scam of Satyam and Satyam scandal, SEBI inability to prevent NSCL scam, failure of SEBI's regulation to prevent misuse of participatory notes, that is P notes, one of the tool for participating in portfolio investment by foreign investors. So these are few things where still strong regulation is needed, and where SEBI is not able to stop the kind of the kind of activities which are being taken place and which are not allowed as per the rules and regulations. Conclusion, as you can see, there is a need of continuous monitoring and improving market intelligence to strengthen enforcements. Also, India's financial market and are still segmented, and unified financial regulator may be required to remove overlap and excluded boundaries. We can also understand that the kind of dualism exists in India with respect to investment in financial market. As you can see, a lot of digital divide is still present. Financial literacy is still not that up to the mark, right? So that more and more people can participate. So these are few things on which we have to work upon. Now let's talk about RBI's gold reserve. RBI's gold reserve, part of foreign exchange. RBI's forex, right? So what is there in gold reserve that we need to? The RBI's gold reserve touched 794 metric tons in fiscal 2023, fiscal year 2023, an increase in near 5% over fiscal year 2022, according to gold reserve. With respect to gold reserve, meaning it is the gold held by National Central Bank, right? That is RBI. A guarantee to redeem promises to pay depositors, note holders, right? When on the currency note, when you see that I promise to pay this much amount to the bearer of this particular currency note. Now, from where that particular promise is coming, what is the basis, what is the backing that that particular promise is there? So the kind of gold reserve that the RBI is having, right? Regulate guarantee to redeem these paid depositors, holders, paper money, etc. In the era of gold standard, a monetary system until 1971, in which the standard economic unit of account is based on a fixed quantity of gold, right? Currently a store of value to support value of the national currency. So now the central banks need to hold certain amount of gold so that it can back the kind of currencies they have printed, right? Why gold is used as a reserve in central bank? So unlike fiat currency, for example, this currency notes that are there, right? So they are known as what? Fiat currency, because they don't have any intrinsic value on their own. So they are known as what? Fiat currency. Earlier, when we used to have metal coins, gold coins, etc., so they used to have their own intrinsic value as well. But when we talk about paper currency notes, they are not having any intrinsic value of their own. So they are known as what? Fiat currency, right? Which can be subject to inflation or devaluation due to various economic factors. The value of global tends to be relatively stable over time, which makes it an attractive asset for central banks to hold as a reserve. Additionally, gold is highly liquid, which means it can be easily converted into cash or used to settle international transaction as well. Composition of India's gold reserve, as you can see, 794 tons of gold reserves included gold deposits of 56.32 tons. 437.22 tons of gold is held overseas in safe custody with the Bank of England and Bank of International Settlement, that is BIS. Right now, recently the RBI has put effort to bring back this entire gold which they were keeping outside the country. 301.10 tons of gold is held domestically. Comparing with total foreign exchange reserve, if we talk about as of March 31st, 2023, India's total foreign exchange reserve stood 578. Now this value has crossed to 700 billion, and gold reserve were pegged at $45 billion, right? Share of gold in total foreign exchange increase from 7% to 7.81% as compared to March 2022. Why are these reserves increasing? Because RBI has been adding gold to its reserve to diversify overall reserves. This change in strategy has been driven by negative interest rates in the past, the weakening of dollar, global uncertainty, and rising inflation. A gold is considered a more safe, secure, and liquid asset. It can safeguard RBI returns. What are the other central banks doing? For example, like in US, we are having US Federal Reserve. Many other central banks, including the Monetary Authority of Singapore, that is MAS, the People Bank of China, PBOC, etc., have been buying gold. So they are also buying gold. The two key drivers behind the decision to hold gold is its performance during crisis time and its role as a long-term store of value. Right now, Harbinger 2023, RBI announces second global hackathon. This is a hackathon where RBI announces for inclusive digital services. The Reserve Bank of India, RBI, recently announced the Harbinger 2023, a hackathon. The theme of this hackathon is inclusive digital services. Competitors from 22 different countries will participate in this hackathon. They include Israel, Philippines, Singapore, Sweden, US, and UK. RBI also receives 363 proposals from Indian candidates. The hackathon is to be conducted in 4 segments, namely digital banking, regulation, transaction, and the use of blockchain in all these transactions. Now, what is the significance of this hackathon? Why this is being planned, etc.? So the central bank invited fintech, that is financial technological enterprises, to participate in this hackathon. They will develop solutions that will aid the differently abled people to access digital financial services. Also, the fintech will work on increasing the reach of digital currencies of the central banks, right? Benefit of this hackathon is participants of the hackathon will get opportunities to interact with industrial experts. Some of them will be mentored by them. Also, new fintech can exhibit their innovative solution. Prizes, if we talk about, the winner of the hackathon will be awarded 40 lakhs and the runner up will receive 20 lakh rupees, that is the cash prize. History: the global hackathon was first started in 2021. The result of this hackathon were announced in 2022. This is the second hackathon being conducted by RBI. The theme of first hackathon was smarter digital payment. The second is inclusive digital services. RBI chooses the theme based on its current activities and requirements. For example, in 2022, RBI was RBI was promoting its Bheem app. Now, international recognition of the app just began, and thus smarter digital payment. Today, RBI is focusing on digital currency, thus inclusive digital services. This is theme for second hackathon. SEBI launches mechanism to curb market abuse, right? So, Securities Exchange Board of India, again part of financial market. The RBI India defines market abuse as misuse of information, benchmark manipulation, and market manipulation. Today, there are no regulation to monitor and control market abuse in the country. Therefore, SEBI has stepped in and launched mechanism to put an end to market abuse. Now, what is mechanism? First, the mechanism will monitor and control unauthorized trading. It will stop firms from facilitating mule accounts, right, where fraudulent activities are taking place. The mechanism will focus on ending spoofing, pump and dump, and disproportionate trading. The mechanism says that the brokers and trading firms should compulsorily report to SEBI. The SEBI has given a list of instances where there are increased possibilities of price manipulation, mis-selling, front running, etc. The terms used here is front running. For example, when we talk about front running, it is illegal practice of buying securities. Price manipulation, that is affecting the supply and demand of company's product artificially. The purpose here is to increase or decrease the price of stock of the company. When you are doing it deliberately, then it is illegal, prohibited. When it is happening due to market forces, that is demand and supply, then it is fine. But when you are altering or influencing demand and supply deliberately by restricting supply or increasing supply, or restricting demand or increasing demand, then it is not allowed. Mule, when we say receiving and transferring illegal money. For example, sometimes person receiving the money are unaware person receiving money are unaware that the money is illegal. Accounts used to mislead the innocents to getting illegal money are mule accounts. When we talk about spoofing, a trader places huge orders on a share publicly visible to the world, but his intention is not to keep them for a long, just to manipulate the pricing of share. They are doing this. Pump and dump, when we say boosting stock prices through fraudulent misleading ways. In short, the mechanism aim to put an end to the above practices, the kind of terms that we have discussed here. Now, the RBI guidelines on climate risk sustainable finance, when we talk about, in July 2022, RBI released a discussion paper called Climate Risk and Sustainable Finance. The discussion paper of RBI analyze an issue from different angles and provide solution to guidelines to solve the problem. Based on the climate risk and sustainable finance discussion paper, the bank is to release guidelines on accepting green deposits, a framework to deal with climate related financial risk. About the guidelines, when we say, RBI says that climate change has the full potential to transform into climate related financial risk. The guidelines are not yet released, but RBI will release it in a phased manner. The guidelines will have all instructions related to climate risk, right? So what are climate related financial risk? Let's understand. The RBI discussion paper defines the term as potential risk arising from climate change. The climate related financial risk occur in two main forms. They are physical risk and transaction risk. According to this discussion paper, physical climate related risk are those risks that come directly from climatic events, right? Whatever climatic events are taking place. For example, we have seen Kerala floods, Jammu and Kashmir floods, Himachal floods, etc. This include risk from storms, floods, wildfire, etc. Wildfires in Himachal, Uttarakhand also. The transition risk are those risks coming from this climate change related policies, technologies, etc. The green deposits are fixed deposits. The only difference between ordinary fixed deposits and the green deposits is that green deposit, the amount deposited in the bank, will be used to implement renewable energy projects, right? So that we can go for adaptation and mitigation related to the climate change, because climate change is real. So when climate change is real, the challenges imposed by them is also real. So we need to go for adaptation, we need to go for mitigation, and then we need fund for that, that is related to climate change fund, right? And finance. Large exposure framework guidelines of RBI. So RBI, the Reserve Bank of India, has dismissed concern about the exposure of Indian banks to the Gautam Adani led conglomerate, right? A lot of loans have been given, the controversies related to this Gautam Adani enterprises, right? RBI observations is the RBI has a central repository of information on large credit, that is CRILC, on large credit database system, where the banks report their exposure to of 5 crore and above, which is used for monitoring purposes. The banking sector remains resilient and stable. Various parameters relating to capital adequacy, asset liquidity, provision coverage, and profitability are healthy. For example, when we talk about health of a financial institution or banks, there is CAR, capital adequacy ratio, what kind of capital the bank is having, right? Tier 1 capital, tier 2 capital, depending upon what kind of varied liquidity that are present, right? Tier 1 capital having more liquidity, tier 2 capital having less liquidity, divided by the kind of risk that are attached to those loans, right, that has been given. So risk that are attached, risks. Banks are also in compliance with the large exposure framework guidelines issued by the LEFR. Guidelines aim to monitor and limit losses of a bank from client or corporation. It is based on 2014 Basel guidelines, like Basel 1 norms, Basel 2 international norms, these are, right? An exception to LEF is banks need not report exposure if the loans are taken from RBI, is guaranteed by Government of India, or have intraday interbank exposure, or deposits are maintained by NABARD due to National Bank on Agriculture and Rural Development due to shortfall in target of priority sector lending. What is priority sector lending? Certain when banks are extending loans, then certain percentage of entire loan amount, for example 40% for commercial banks, domestic commercial bank, they have to lend in priority sectors like education, like small and marginal farmers, agriculture. Basically, under agriculture we have already also created separate segment for small and marginal, right? SEBI tweaks operational framework on credit rating agencies. What are credit rating agencies? For example, this Moody's, etc. They are credit rating agencies. Market regulator SEBI has made changes in its operational circular on credit rating agencies. Previously, SEBI has released an operational circular on credit rating agencies which was to come into effect on February 1st. SEBI regulation for credit rating agencies: at the time of withdrawal of any credit rating of securities that are listed to stock market, the CRA would have to assign a rating to such securities and issue a press release in a prescribed format. A press release should be mentioned the reason for withdrawal, why they are withdrawing this particular ratings. MD or CEO of CRA or any person within CRA who has business responsibility would not be a member of rating committees of the agencies, right? So there should be a clear distinction between the people who are working for credit rating agencies, right? CRA should have a detailed policy by March end in respect of the non-submission of crucial information by the issuer, whosoever are the issuing. For example, initial public offerings, follow-on public offerings. These are the offerings that the companies do from stock market, right? So what kind of policies they are having, right? And they need to furnish this information which is required, and SEBI also audit their report as well. So those information should be made available to SEBI. SEBI, founded in 1988, is a statutory regulatory body. I have already made it clear that when in 1988, when it was established, it was not a statutory body. Rather, it was functioning under Ministry of Finance. But what happened later, because of many fraudulent activities, etc., it made a statutory body in the year 1992, and it became a this autonomous body, right, for the securities and commodity market in India under the ownership of Ministry of Finance. Right now, it is not under Ministry of Finance. In 1992, it became statutory body, and now it is autonomous. Do's and don'ts related to green debt securities to avoid occurrence of greenwashing. SEBI has notified that issuer of green bonds shall continuously monitor the environmental sustainability of the project, shall not be involved in greenwashing, and shall inform direct and indirect harms to the environment. What is green bond? If we talk about, a green bond is a debt security issued by an organization for the purpose of financing and refinancing projects that contribute positively to the environment or climate. A green bond is alternatively known as climate bond also, right? So it is for investing in renewable energy like solar energy, etc. That kind. Why has the RBI withdrawn rupees 2000 notes? That is related to demonetization. When demonetization happened in 2016, so at that point of time, what happened? 500 and 1000 rupees note were withdrawn, right? That will not remain a legal tender. But after that, 2000 rupee was introduced, right? So 2000 rupee have now RBI has withdrawn 2000 rupee also. With the fulfillment of the objective, the printing of 2000 rupee note was stopped in 2018-19. The RBI issued the majority of 2000 denomination notes prior to March 2017, now at the end of their estimated lifespan of 4-5 years, right? Therefore, in pursuance of the clean note policy of RBI, it has been decided to withdraw 2000 rupees denomination banknotes from circulation. What is clean note policy? Why it has been withdrawn under the name clean note policy, that we need to understand. So the policy was introduced in 1999 by the RBI governor, then RBI governor Bimal Jalan. It seeks to give the public good quality currency notes and coins with better security features, while soiled notes are withdrawn out of circulation. Under the policy, the RBI had earlier decided to withdraw from circulation all bank issued prior to 2005, as they have fewer security features. So security features, for example, security features, for example, what kind of duplicate notes or the fake notes, that needs to be prohibited. These are the things. Will the rupees 2000 notes continue to be a legal tender? The public can continue to use 2000 rupees banknote for their transaction and also receive them in payment. However, they are encouraged to deposit, exchange these notes on or before September 30, 2020. RBI has not clarified the status of these notes after September 30, but this notes needs to be exchanged, right, from banks in lower denomination like 500, 100, 200. Could there be repeat of demonetization chaos? No, unlikely, as the printing of our 2000 rupee note was stopped in 1819 and they are no longer commonly seen in the public constitute only 10% of the notes in circulation. That is why that chaos will not be there. The decision to withdraw 500 and 1000 notes was announced suddenly, taking public by surprise. That was the case when demonetization. Now, intermediary advisory committee of SEBI, Securities Exchange Board of India. To ensure transparency and efficiency in the operations of market intermediaries, SEBI has established the intermediary advisory committee. Now, the purpose of this committee serves as an essential forum for suggesting changes to the legal framework and promoting transparency in the system and procedures of market intermediaries. By providing valuable insights and recommendations on, the committee aims to improve market safety, efficiency, and the transparency in working of SEBI. Leadership and membership, if you talk about the current chairman of this committee, Ravindran Jain, a former executive director of SEBI. With 21 members, the committee brings together representatives from various industries crucial to the functioning of capital market, right? Capital market where the securities are being transacted. These industries include the brokerage industry, financial institution, legal firms, and SEBI's own members. Notable members, if we talk about among team members, committee, Nitin Kamath, the founder and CEO of Zerodha Broking, a prominent name in the brokerage industry. Lalit Keshar, CEO of Grow, a popular investment platform, also lends expertise to the committee. Their inclusion reflects the importance of industry leaders also in shaping policies in impact market intermediate. So it is not only government dominated or SEBI dominated, rather experts from market have also been taken into consideration. Additionally, the committee benefits from the insight of Ashish Chauhan, the managing director and CEO of NSE, that is National Stock Exchange, and Sundraman Ramamurthy, MD and CEO of Bombay Stock Exchange. Their contribution bring valuable perspective from major stock exchange in India, right? This is related to the committee. Representing the committee, Commodity Participants Association of India, Narendra Wadhwa, President, and Vijay Mehta, President of the Association of National Exchange Members of India, uh, bring specialized knowledge in their respective fields. Their presence ensure a comprehensive understanding of market dynamics and the need of market participants. So these kind of people are there who empower this particular committee. Driving regulatory enhancement, SEBI Intermediate Advisory Committee plays a crucial role in advising the regulator on measures to simplify and enhance transparency in system and procedures related to market intervention. It also emphasizes the adoption of technology and cybersecurity by intermediaries to ensure compliance and safeguard market integrity, right? SEBI recommendations on mutual funds, if we talk about the capital market regulator, Securities and Exchange Board of India, that is SEBI, has recently put, if we talk about recommendation on mutual fund fees, for example, when we talk about mutual funds, we make a unit, as I told you earlier as well, that they create a unit from different shares, etc. So these shares can be from different forms, different sectors of the economy, right? So they create one unit. So what kind of fees they charge, in fact, related to portfolio, making portfolio, etc. Recently put forth a series of proposals aimed at reforming the fee structure of mutual funds. These changes seek to enhance transparency, reducing mis-selling, and make investing in mutual funds more cost effective way. Uniform total expenses ratio, if we talk about TER, SEBI has recommended implementing a uniform total expenses ratio. What kind of expense they incur when they create this portfolio, etc., for different scheme categories such as equity or debt. When we talk about equity, that is related to having ownership rights in the firm. When we talk about debt, it is you are extending loan to that particular, right? Currently each scheme is allowed to charge a separate total expense ratio, TER, based on asset size, right? Under the proposed changes, the TER will be calculated at the asset management company level, ensuring consistency across all schemes within the same fund house. Now, when we talk about lowering the cost, the objective behind this proposal is to lower the cost associated with investing in mutual fund by streamlining the TER. SEBI aims to bring down the expenses for investors. So when it will come down. So what kind of advantages we can have? So one among them is better participation of the people, because it will be liberalizing this entire ecosystem. The revised TER slabs are projected to result in TER reductions ranging from 0.5 to 20% depending upon size of the assets, right? Inclusion of GST and transaction cost when we talk about. So SEBI has suggested the inclusion of GST on investment and advisory fees as well as the transaction cost in the total expense. This move aims to provide investor with a clear picture of the overall cost associated with their investment and aligns with the broader objective of transparency. When we talk about performance fee, another notable proposal is the introduction of a performance fee that mutual funds can charge investors for superior returns. This fee structure incentivizes fund managers to achieve a better performance, aligning their interest with those of the impact on small AMCs, right? Small AMCs, when we talk about asset management companies, SEBI has taken into consideration the interest of small, because they are not having that much profit, etc. So smaller asset management companies, and has proposed revised TR slabs that ensure they are not at disadvantage. This step encourages healthy competition among AMCs of all sizes, right? This is related to new guidelines of AMCs, right? Now, SEBI is also having a risk disclosure framework for individual traders in equity derivative segments, right? Equity derivative having ownership. To enhance investor protection and promote informed decision making, the SEBI has introduced a new risk disclosure framework for individual traders in the equity futures and options. Futures and options, like in the way we are trading, right? This framework, which will come to force from July 1, aims to provide detailed information about trading risk and empower investors to make well-informed choices. Now, requirement for stock brokers. In this new policy, there is requirement of stock brokers. Under the new framework, the stock brokers are obligated to display risk disclosure on their website and inform their clients on a specified manner. Upon logging into their trading accounts, clients will encounter a pop-up window prompting them to read and acknowledge the risk disclosure before proceeding, right? Prominent display of risk closure. If we talk about to ensure maximum visibility, the risk disclosure must be displayed prominently, covering at least 50% of the screen. This ensures the traders have clearly visibility of the potential risk involved in their trading activities. So it is to inform, to take care of the interest of the investor, so that investor cannot be disguised or cannot be misguided, right? Depending upon how they are sometimes estimate profit. So they have to show risk also covering at least 50% of the screen. Empowering investors with information. SEBI recognizes the increasing participation of investors in Indian securities market, right? The participation has increased to a great extent in last few years, especially in the derivative segment. When we say derivative segment, the price is derived from certain commodities or certain other financial asset. By providing detailed information about trading risk, this risk disclosure framework empowers investor to make informed decision based on their own due diligence and risk appetite, right? Maintenance of profit and loss data. So the qualified stock brokers have been directed to maintain a profit and loss data on their clients on a continuous basis. This data should be retained for a minimum of 5 years, ensuring transparency and accountability in trading activities. Insight from SEBI study. That SEBI conducted a study revealed a significant insight about individual traders in the equity, this future and option segment during the financial year 21-22. The study found that 9 out of 9 out of 10 traders incurred net losses with an average loss of 1.1 lakh rupees. Conversely, only 11% of the individual trader made a profit with an average profit of 1.5 lakh rupees. So to take care of retail investors also. SEBI guidelines for IPF and ISF. Let's see this. This comprehensive guidelines were issued recently by SEBI for the Investor Protection Fund, that is IPF, Investor Protection Fund, and Investor Services Fund, that is ISF. These guidelines cover various aspects including consultation, management, contribution, and utilization of the funds. Additionally, SEBI has provided a standard operating procedure, that is SOP, to outline the process and timelines of key activities related to investor protection and services. Now, as you can see, how we can understand these guidelines. So understanding these guidelines, first, SEBI guidelines aim to ensure that the effective functioning and management of the IPF and ISF maintained by stock exchange and depositories. The IPF guidelines encompass the constitution of fund, role of trustees, contribution mechanism, and utilization fund. Similarly, for ISF also, funding resource, utilization strategies of the investor services fund. Now, when they will become effective, so effective date of implementation is June 29 as the effective date for implementation. Trustee composition of IPF, if we talk about, both stock exchange and depositors will consist of 5 trustees. This includes 3 public interest directors, 1 representative from investor association, and a chief regulatory officer or compliance officer. So 5 members will be there. The maximum tenure of trustee, excluding chief regulatory officer or compliance officer, will be 5 years, ensuring periodic reviews and fresh perspective, right? So it will be new members will come in. Contribution mechanism will be to ensure the stability and adequacy of the IPF. SEBI has outlined a specific contribution mechanism for stock exchanges and depositories. Stock exchange will contribute 1% of the listing fees received every quarter. Additionally, the interest earned on the security depositors kept by issuer compliance during public offering and penalties collected from trading members and also be channeled into IPF. Depositors, on the other hand, are required to contribute 5% of their annual profit from depository operation, right? This is this will be the mechanism. And utilization of ISF and IPF, if we talk about, the fund from IPF will be utilized to meet investment claims or of clients affected by defaulting trading members, right? When members are defaulting, provide interim relief to the investor and support investor education initiative. The ISF, on the other hand, will primarily focus on promoting investor education awareness program, right? SEBI emphasizes that at least 20% of the listing fees received by stock exchange must be set aside for ISF to ensure effective services to the investing public, right? Unutilized balances and continuity. To maintain continuity in investor protection, SEBI has established provisions for the transfer of utilized balances from the IPF and ISF in the event of stock exchange, right? Fostering investor confidence, if we talk about, if we are focusing more on investor awareness, education, and providing relief during this kind of defaults, etc., then it will also boost the confidence of the investor. Now, SEBI framework for unexplained suspicious trading pattern. For example, if a kind of trading pattern like insider trading, etc., is there, so what kind of framework that is there under SEBI? SEBI has proposed a robust regulatory framework to address the issue of suspicious trading patterns in the financial market, prohibiting individuals from engaging in suspicious trading activities related to material non-public information. SEBI seeks to ensure transparency and integrity in the securities market. Understanding the proposed framework, right? SEBI regulatory framework specifically targets the phenomena of suspicious trading patterns. The framework seeks to prevent individuals from participating in the trade that revolves around material non-public information unless they can effectively rebut the presumption of violating security laws. By doing so, SEBI aims to address insider trading and front-running practices that undermine market fairness, right? Now, prohibition of exploitation and material non-public information. According to SEBI, the presence of material non-public information that can reasonably impact the price of security, particularly in the form of impending recommendation by influencers, is of great concern, right? So SEBI define influencers and individuals capable of influencing investment. For example, you might have seen over social media, Telegram, Instagram, etc., that people sometimes promote certain things and influence the decision of the investors. So these are the things. What are the challenges for violation? Establishing the violence acknowledges difficulties in faces in establishing violation in case of involving encrypted or vanishing messages, for example using Telegram service, right? Such communication methods make it arduous to establish direct connection between tipper and tippee in insider trading scenarios, right? So these are some challenges related to establishing those violations. Now SEBI testing framework for IT system of Market Infrastructure Institution, that is MIIs. India's regulatory body, that is SEBI, has introduced a new framework for testing IT system used by Market Infrastructure Institution or MIIs, including stock exchange, clearing corporation, and depository. The objective of this framework is to assist MIIs in performing through risk assessment before deploying any IT system in the production or live environment. MIIs will be this required to undertake system testing, functional testing, and application security testing under this new framework. So their apparatus, etc., will be checked and will be tested. Now the approval process will have 30 days to submit testing framework all their IT systems, which needs to be approved by the Standing Committee on Technology, that is SCOT of respective institution. SCOT of the responsibility of giving approval to the all-inclusive approaches for testing the system functional and application security methodologies, right? Now, testing scope, if we talk about, MIIs are required to perform white box testing or structural testing, which involves analyzing data flow, control flow, information flow, coding practices, exception and error handling. Because since everything is happening online, so these systems should not be having any malware, any a different software or something like that, which can influence the trading mechanism, right? Bugs also, bug fixes, so all identified software bugs, issue or defects should be remediated immediately. Major issues that could hurt the MMI should be reportedly to their SCOT, that is there in that institution. MI have been asked to establish policies and procedures on the use of third party system, right, which can influence the kind of working of these systems, ensure these systems are subject to review and testing before they are integrated with their system, right? Importance of testing, if you see, testing is critical to identify software bugs, issues to defects and IT system efficiently, properly and efficiently. So these are related to guidelines of SEBI with respect to the kind of the kind of system which are being used. Now the new topic is there related to debt banking, right? So what caused Silicon Valley Bank's failure? So if we talk about the downfall of the US based Silicon Valley Bank, it is the largest failure of financial institution since the global financial crisis of 2008, right? In 2008 we have seen the subprime crisis. Now it is after that it is the big one. So what went wrong with this Silicon Valley Bank? The financial institution, best known for its relationship with high-flying world technology startups and venture capital, experience a bank run. Bank run means it is a situation where the depositors who have deposited their money, they went to withdraw their money and somehow they could not withdraw money, and then the kind of uh, in market or in economy, now the word spread that this bank is not able to uh, pay back, right, the depositors money, and hence all people rush towards the bank to withdraw their money, and this bank runs out of the capital. So this is known as bank run, right? So a bank run, which is typically the result of panic that the customer withdraw their deposit simultaneously rather than true insolvency. So this is not insolvency, but since everybody is at the same time they want to withdraw their money and that much capital is not there, so that pushes a bank into actual insolvency. So earlier insolvency is not there, but the rumors or maybe the spread of word is causing insolvency. Bank runs have occurred throughout history, including during the Great Depression period and the 2008-9 financial crisis, also known as subprime crisis. Next, what happened that the SVB's large deposit, that is startups and wealthy tech workers are unsafe. The federal government ensures deposit of 250,000 US dollar, and anything above it is considered uninsured, right? Like in India also we are having 5 lakh rupees deposit insured by DGIC, and above that it is not insured, likely to be released in an orderly process. Many businesses want to access fund to meet payroll and offices expenses, could lead to furlough, that is layoff, right? There is no buyer of this SVB. So is this a sign of repeat of 2008 global crisis? We cannot say that, but SVB was large but had a unique existence by servicing nearly exclusively the technology world and this Silicon Valley or VC company, that is venture capital backed companies, right? Other banks are far more diversified across multiple industries, so if default happens for one or more industry, then also they are able to manage the crisis. But since it was only for the startups related to technology, so it faced a lot of difficulties bases and customer bases and geographies, and could survive a deeper recession and a significant rise in unemployment. However, if we talk contagion effect from SVB or higher interest rates hit more foreign banks, a flight to safety among global investor could hit capital flow into emerging markets, right? The contagion effect explains the possibility of the spread of economic crisis or boom across countries or region. The fundamental underlying this scenario where price movements in one market are resultant of shock or volatility in the other market is a perfect information. Now the impact on Indian economy, if we talk about, many startups, especially in the SaaS, that is software as a service sector, not only have account, but the bank had also been an important lender. So for India also, for example, investment of total $1.7 million in 197 Communication, the parent company of Paytm. As the funding of the startups is dwindling, this could prove to be a major roadblock, especially for young business. The flight of capital could also impact the software industry, right? So this is related to Silicon Valley Bank. So we'll stop here for today. We will see another updates in the next class on the same platform of Victory IS. So thank you very much. Take care. Bye bye.